Hello and welcome to another educational video brought to you by Bayntree Wealth Advisors. My name is Cristina Perez and I'm a certified financial planning professional. Today we're going to talk about why tax planning is important. First, a general disclosure. This video was made for educational purposes only. It should not be seen as specific investment or tax advice. We are providing education and guidance for you to take back to work with your tax professional. So, to summarize the tax benefits or tax planning benefits, you can really think about it in three main ways. It's going to allow you to maximize your tax breaks, minimize tax liability, and therefore maximize your savings. So the first thing you're going to want to do is know what tax bracket you are in. So you can do that by looking at your previous year's tax return. And it's important to understand our tax system is marginal. So therefore, not all of your tax or your dollars get taxed the same. You'll see an example on this slide here that shows if your income is $32,000 and this is taxable income, so after any deductions is $32,000, then the first $9,950 get taxed at 10%. Then every dollar after that amount, so every dollar in between $9,951 up to $32,000 would be taxed at 12%. So step one is going to be knowing where you currently stand to see if you make any changes where that might push your tax bracket or decrease your bracket to. It's also important to understand the difference between a tax deduction versus a tax credit. Here you'll see two examples, one for a $10,000 tax deduction. You'll see that that is right below your adjusted gross income, and it lowers your taxable income. Whereas you'll see on the second example, which is a $10,000 tax credit, the tax credit is used at the very end to pay less in your tax liability. So that's going to be one of the main differences to keep in mind as well. In addition to understanding your current brackets and the way the brackets work, in addition to understanding the difference between tax credits and deductions, it's very important to understand the difference between taking the standard versus the itemized deduction. And it's also important to keep in mind that these figures shown on the screen are thanks to the Tax Cuts and Jobs Act. So that may be sunsetting or expiring at the end of 2025, and the standard deduction may revert back to what it was prior in 2017. So that's something to keep an eye on. But this is the standard deductions as it stands right now. So essentially, in order for the itemized deductions to be more beneficial for you, they would have to be over these amounts. And here is a list of records that we would recommend you keep in case you ever get audited, or mainly for your tax keeping records. And there's a list of categories as well as specific documents that you might receive. This is not a comprehensive list, so there's plenty of other documents that you might want to hang on to as well. But these might be very helpful, as I mentioned, in the event of an audit. And once you've done the first few steps that we've mentioned, then you can start to think about what tax strategies you might want to implement to either decrease your current year tax liability or potentially decrease your future tax liability. That would mean using more of a Roth component, which doesn't give you a tax benefit on the front end when you're contributing, but of course, anything that is Roth would come out tax-free later on. So you can consider changing your W-4 withholdings if you maybe had a big tax bill due and you want to essentially save a little bit more of your paycheck and withhold for that future tax liability. You can consider putting money into a 401k, either traditional, which would be pre-tax contributions, which would give you a current year tax benefit, or you can potentially use Roth 401k contributions if available. And again, that's not going to give you a current year tax benefit, but it will give you a tax benefit later on. You can also utilize IRAs, pre-tax and post or Roth. So very similar to 401k contributions. You can also fund a 529 plan if you have young ones or any beneficiaries that you're wanting to save for college. And actually, it's not just limited to college at this point. It depends on your state and the 529 plan, but some of them even allow you to use the funds for K through 12 schooling as well, or even graduate programs as well. Consider using flexible spending accounts or dependent care flexible spending accounts, as well as HSAs. And a little bit more about the traditional 401k contributions. As I mentioned, these are made with pre-tax dollars. So any amount that goes into here would be excluded from your income. But again, this is giving you a tax benefit on the front end. So later on, when you distribute from any pre-tax 401k or IRA, you will get taxed. And it's going to be the opposite for Roth 401k contributions. Since you're not getting a tax benefit when you contribute, the withdrawals eventually will be tax-free. And here's a nice summary outlining the differences between traditional 401k versus Roth 401k. So one, again, is going to give you a tax benefit now. That's the traditional, versus the Roth 401k is going to give you the tax benefit later via tax-free withdrawals. In addition, something to be mindful of is traditional or pre-tax assets will be subject to required minimum distributions beginning at the age of 73 up until the year 2033, when that age will go up to 75. And the Roth assets are not subject to required minimum distributions, which is very nice. And so what is right for you? There's never going to be a one size fits all or a very clear answer. At the end of the day, what's going to be right for you is going to depend on where you think your income is going to be in the future. So we do have to make assumptions. So if you don't know for sure, it's sometimes best to do a little bit of both. Again, we would recommend you consult your financial advisor or your tax advisor to come up with the best amount for you to contribute, or tax strategies in general for your situation. And lastly, here is our contact information. So if you do have any additional questions, you can definitely feel free to reach out. Thank you, and hope you have a great rest of the year.